Hi, and welcome to the Intentional Wealth Update from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys today?
Good, how are you?
Good. So we're having a volatile week this week in the stock market. There's a lot of different catalysts at play. And what we want to do here in all of these updates, not so much talk about what just happened in the stock market, but what are the forces at play and how can we be prepared for the things that might be coming down the line. So in that context today, we're going to start by talking about interest rates. We're going to dive a little bit into some of the inflation numbers and expectations, and then we're going to finish up talking about goals. So Cody, let's start off talking about interest rates. We found a Schwab article from Kathy Jones, who's Schwab's fixed income specialist, and talk about volatility. What do we know about what's happening with interest rates right now?
Yep. So the Fed has started to raise the interest rates over the past couple of months to try to slow down the growth of our economy, to hopefully slow down the inflation numbers that we've seen here recently. And the rate that we're going at, some of these interest rate hikes are a little faster than what we've seen in the past. And that's why we've seen a large jump in some of the shorter term treasury yields.
Right. And Katie, what jumped out at you was, so we're going to be on this trajectory of higher rates for some period of time. But then the question is, how long do they stay there? What did Kathy point out on that side?
Right. Well, and just to reiterate what Cody said, it has been a really fast movement as far as these rate increases. These are like on par with rate increases, the speed of which was happening in the 1980s. I mean, we went from 0.25% to 2.5% in about 6 months. And the projection is that we might top out somewhere around 3.5 or 4% as being like the high water mark, so to say, probably early next year. I think one of the things that jumped out to me is that you don't typically stay at that plateau for too long. On average, looking at historical periods of time where we've had interest rate increases, on average, they start to trend down at about 9.5 months. There have been a couple of times it spread out to about 18 months, but point being, it's not a place that hopefully we stay for too long, and there will be some measures taken to kind of spur the economy again.
And the reason why those rates come down, it's because economic activity declines. We get some sort of a decline that the Fed starts to pull back a little bit, having overshot. And that's the thing that we're watching is what is the willingness to overshoot to the upside, and then how quickly do they start to pull back? Which if you're a fixed income investor, that matters, right? Because then you start seeing your bonds act like the defensive force that they should be, because when rates come down, bonds go up. Mm-hmm. So, yeah, and another thing, this is pulling on another piece article that we had looked at before. It changes the math on a lot of things. When you're looking at the rates of interest, when short-term rates go higher, it changes the math on things like, should I pay off my mortgage before I get to retirement? Because the rate that you can earn on safe money, if it's more than what your mortgage is, then maybe you should keep the mortgage as you go into retirement. So rising interest rates are one of those catalysts that might require you or nudge you to revisit your plan or revisit the thinking on certain decisions.
Right. And Kathy also points out that it's probably not a bad idea to start building in some of those pieces with higher interest rates, but be very careful with the credit risk. Like make sure to stay, with quality bonds, quality instruments, watch the credit risk, but you can probably start building in some things a little bit higher. You can start picking up a higher yield on the other side.
Yeah. The thing that's paying you 3 or 4% now is not the same credit quality as what was paying you 3 or 4% a year ago or something like that. So don't conflate the two. Right. Good point. All right. So we had inflation numbers came out this week. We're talking about where inflation was. And the thing about, when we think about inflation, it's a backward-looking figure. What did things just go up last month? Cody, we looked at an article from the Wall Street Journal about inflation expectations, New York Fed report. What do we know about inflation expectations among consumers?
Yeah, so there was a good article in the Wall Street Journal that was going over a survey that the New York Fed did earlier this week on what the consumers expect the inflation numbers to be a year from now, 3 years from now, and 5 years from now. And the consumer expectations came down for all those time periods. So over the next 3 years, they expected inflation to be closer down to 2.8%, where compared they were around 3.5 just 1 month ago. And then 5 years from now, their expectations were that inflation would hopefully be back down to 2%, which again was a pretty good decline from where they just thought the expectations were a month ago.
Right. We were trying to talk about where expectations play into investment decisions. And this is one of those cases where the consumer can almost will something into existence. If we have 20% returns for a couple of years in a row and the consumer expectations are for another 20% in the year to come, that's usually not what happens. But in this case, if they expect prices to be higher in the future, they'll do more buying now, which drives up demand, which raises prices higher. But if they expect them to be lower, the opposite happens, and it actually starts becoming self-fulfilling. Inflation's weird like that.
Very good point.
What did you take from this one, Katie?
I took it as a good indication, and I think it does fit in a little bit with some conversations that we've had before, acknowledging, recognizing that we are in an environment that has higher inflation than we've seen in a really long time. But there are components of it that we do expect to come down, and we do expect to return to somewhat normalized levels going forward. And I think we're trending in that direction. Maybe not as fast as the Fed would like us to, but we are definitely trending a little bit. And I think that the consumer is, as you said, they're resetting their expectations as well.
Yeah, I think the thing we've all been wishing for is that for the pace to slow down. Like directionally, things have gone any number of ways. We've had low inflation and high, we've had low markets and high, but it's all been moving at such, the bandwidth has been so narrow. But I think we're just waiting for things to space out a little bit so we can have time to make better long-term decisions. At the very end of the article, the one beam of light that I saw was they quoted saying consumers were more optimistic about their future household income and financial situations. Wait a minute, we're seeing some optimism. We've cited that University of Michigan study that said consumers are more pessimistic than they've been in the last 50 years, which is that things aren't great now, but that's crazy.
Yeah. And it's amazing how quickly that flips and that turns. So we do always have to take things with a little bit of a grain of salt. I mean, even just from last month to this month, that was a pretty big change in consumer expectations. So just to be aware of that, but it is also important to have an idea of where those trends are heading.
Yeah. That's why Warren Buffett has that Mr. Market persona for the stock market. He says, sometimes Mr. Market just wakes up on the wrong side of the bed. And just that doesn't feel great. It's a very fickle thing. Applies to a lot of things. All right, so I want to talk about one more thing. So that the first casualty of any bear market or crisis or bad day in the stock market is people's confidence in their goals. Can I do it anymore? Does something need to change? Do I need to bail out of this strategy? We found an article it was in the Humble Dollar blog, and really nice breakdown of why goal setting might be problematic and why you might not want to set goals. Katie, this one jumped out at you, right?
Yeah, we've talked about this before too. Sometimes when you set those goals and you reach a gate, then you look up and you say, okay, now what? And so you almost have this letdown of, okay, awesome, but it's difficult to say this is the thing that's going to make me happy. This is the thing. And to really kind of pinpoint that's going to make me successful, or that's going to, whatever the case may be, because it's never one thing. It's always a combination of things. And I think recognizing that putting a singular goal out there may not accomplish all the things that you're trying to accomplish. And so I really liked how the article helped you to rethink goal setting.
Katie, you and I went through this with the business, having a big, hairy, audacious goal for the future. And we struggled with, is it too big? Is it too small? Is it just right? I don't know. And it wasn't until we started thinking about the qualitative stuff along the way that we're like, okay, this becomes something that we set it far enough out there, but it's still just a way station. It's still just something we're going to hit and move past and go on to the next thing, right?
Right. One of the things that really resonated with me in the article is I like the idea of the big audacious goal out there, but almost having gates along the way.
Mm-hmm.
So you say, okay, that's where I'm headed, but I'm going to cheer and be excited when I get to this point. And I'm going to cheer and be excited when I get to that point. And I'm going to work really hard to get to that point. And so that constant movement, but also reflection. And this wasn't fully articulated in the article, but it is something that we talk about as a team, taking that time to reflect on what has been accomplished and to get really excited about those gates along the way.
Yeah, I mean, it is a habit you build. And Cody, we saw this with certain athletes. I mean, you see, if you ever watch the documentary, I forget what service it was on, but on Michael Jordan during the 1990s, and just after winning championship after championship, there just wasn't, he needed to fill that void somehow. And then Michael Phelps has talked openly about that. You know, there's the most wildly successful Olympian ever, yet when it wasn't winning gold medals, but there's a void there. So how do you reset and frame it differently?
Yeah.
The thing I thought was interesting was only pursue those things in life that excite you and can't be finished. You know, just there's never that idea like, now I'm done. I mean, we never think we're done, but just thinking of things that aren't going to be finished, those pursuits. So they give the example of, don't set a goal of running a 5K, set a goal of running a 5K on your path to becoming a runner. There's an identity there, right?
Like, don't set a goal to go on a date night, you know, once a week, but set a goal to be a better spouse. And you're constantly working toward that, which is never fully defined, but it's in the background.
All these books behind me are on how to be a better spouse. So that's how I work on it.
That's good.
All right. Well, thank you for joining us this week. If you have any questions about market volatility or some of those inputs and things that we try and plan for in the future, feel free to reach out and we can include it in future content. But in the meantime, we hope everyone's well, and we'll talk to you soon.